We only lead with what we think are very good ideas that are based on rigorous research and intellectual honesty. And we try to avoid just asset gathering, pitching what the hot product is. People at DoubleLine working on this strategy have a long history of working together. The firm spends a lot of time thinking about culture and fit because we like to make sure that that person's going to stick around for a long time and be a part of our team. And so you see that through a lot of continuity, a very low turnover ratio, and a group that's just very comfortable working together.
What I'm most proud of all is that the turnover rate of the group since the inception of DoubleLine 8 years ago has been 0. And the continuity of the team and period of time working together and people enjoying working together manifests itself in very good performance, very good teamwork. The process is one that's a bottom-up approach and a top-down approach. So the bottom-up approach, each portfolio manager understands and manages the team and finds the exact securities what to put in the strategy and how they all correspond and work with one another. And the committee, from a top-down macro point of view, decides how those various assets should be allocated among the different groups.
It starts with our asset allocation process, what we call FIA, fixed income asset allocation. It's a group of people that have expertise in each particular asset class. A lot of the conversations happen informally. It could be up on the trading desk, it could be an email. These informal conversations get organized in a formal meeting once a month where each expert in their particular asset class talks about what they're seeing.
The first thing the committee does, of course, is review past decisions to see if they worked and what didn't work. It's led by Jeffrey Gunlock, getting a lot of discussion from the rest of the group. Then the next stage is taking a look at the economic and technical fundamentals of each sector. And finally, from that, people come to conclusions of what areas should be overweighted, what should be underweighted. They really want to find that decision that results in the highest possible performance, the smoothest returns for clients, and that's how our interests are aligned.
Managing interest rate risk in this strategy, duration is a key metric. So keeping low duration is a tool for insulating the strategy from large movements in interest rate risk. We take that duration measurement and put another layer onto it. We also look out for spread duration. So we think that the portfolios and the strategies are put together to survive in two scenarios, if rates rise, but also if there's worries about corporate credit, if there's worries about spread widening and default rates starting to increase. And so that's I think a unique focus of the low duration strategy is that it's not just looking at low duration, it's also looking at low spread duration and keeping out credits that we think have risk of that kind of deterioration. I think the real differentiating factor when identifying what's unique about DoubleLine is really the way we all work together as one team, as opposed to in a silo. You'll find many competing firms take asset classes and break them into individual asset class silos. And so what you have is sort of competing resources and competing interests. At DoubleLine, we're all one group, and it lends itself to intellectual honesty and is one of the keys to our success.